What do you think about the second half of 2019? Are we going to see a pickup after a little bit of a lull in the beginning?
Well, thanks very much for having me here this morning. But yeah, we've seen lackluster issuance in high yield for sure. It's been stronger in leverage loans. I don't think we're necessarily going to see a step change in terms of issuance in high yield. I think we'll see a pickup in leverage loans, and typically September and towards the end of the year we do start seeing a pickup as more deals come to the market after the summer lull. But having said that, doesn't take away from what's been actually a very strong year in terms of performance for both of the asset classes. And usually, although what we are seeing is, I think, a mentality shift in the way people are looking at credit at the moment. Usually what happens when we've seen such strong year-to-date returns is that we see that all vessels are lifted by the rising tide. That's not what we've seen so more, and I think there's more caution in the market. We certainly see some sectors that are undergoing structural shifts, such as retail and automotive, lag this rally. And people are looking for quality, especially when we're seeing a slowing growth around the world and the geopolitical tensions. People are looking for a little bit more caution.
Are people looking for quality, for value even, over growth? Or do you expect, tech and healthcare to still be big gainers in the second half?
Well, tech's a relatively small part of the leveraged finance market. Healthcare is an increasingly large part, and we've seen some good selective opportunities there. But what people are really looking for at the moment is strong cash flow and stability in an uncertain environment. So you're seeing sectors such as the TMT sectors, the cable sector, the packaging sector do particularly well in being the area of choice that people want to invest in when they're looking at an uncertain environment going forward in terms of this moderating global growth and indeed all the geopolitical tensions that we're seeing as people are looking for that quality bias.
How interlinked are the high yield and leverage loan markets becoming, James?
I would say increasingly they're converging, and this has been over a number of years, but now we see almost competition between the markets, whereas in the past you'd see typically a leverage loan and a bond being issued in the same capital structure. Typically now it's a choice between the two markets, and particularly with the fall away of covenants in leverage loans, they've become more bond-like in their structure, and it's often now a choice on an LBO whether you do a bond or a loan. So increasingly there's convergence, and increasingly there's funds that are able to do both loans and bonds and make that relative value decision between them, and that's something that's perhaps a difference to, say, 10 years ago.
What has the effect of extremely low, especially here in Europe, negative rates been on the industry?
Well, particularly for high yield and to a lesser extent leverage loans just have a floating rate, but it's caused a massive inflow into the asset class. I mean, when you have more than 50% of the investment grade and sovereign bonds trading at negative yields, and people need to find yield from somewhere, then high yield is an obvious place to go. It's liquid, it's actually showing some very resilient characteristic, defaults remain low, and so it's a very attractive place for people to put their money at the moment to get a good yield, and indeed a positive yield, and quite a materially positive yield compared to many of their other options.